Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Ashima Goyal, Eminent Economist, member MPC of RBI, and Professor of Economics of IGIDIR, joining in on the show. Welcome to the show, Ashima. It's a pleasure to have you and speak to you today. Great insights. I hope you're keeping safe along with family and all your colleagues as well.
Yes, thank you. Difficult times, but
Absolutely. Ashima, clearly, what's happened is with COVID, we have seen unprecedented times. I don't think so any economy or any sector that has been left untouched with the impact of COVID. How would you actually describe the overall impact on economies and the kind of revival that we've already started to see?
yeah, I think we must remember this is a pandemic which you see rarely, maybe once in 100 years, if that. And so it was always going to be very difficult for India, given its poverty and numbers and congestion. So, and that it's a large country and it's difficult to control internal migration. We're a democracy. So I think in given that background, we've done pretty well. Our numbers look really high when you say 10th country, largest numbers. But given our population, remember we're one of the highest populations in the world. So the numbers per capita are not that high. And although we had initially we thought that the lockdown would work, but it was chancy. That is what all those epidemic models were telling us. But
Mm.
it didn't work, and then with the migration spread all over the country. So we've had these ups and downs. In June there was recovery, then it spread internally, and then all those local lockdowns. So but now I think we've been successful in preventing a second peak, as you're seeing in so many countries.
Mm.
I think that's because of our strategy of gradual unlock, as well as preventing large gatherings, use of masks, etc., etc., which seems to have worked. Touch wood. Now we're hearing of this new strain. But and we are also seeing, I think the big difference was in early September when the central guidelines said that states must not impose arbitrary lockdowns, because
Mm.
those were really hurting industries. So once states allowed movement necessary for supply chains to resume, we have seen this revival, which is better than expected.
Right. So, Ashima, I mean, if you talk about growth, especially with regards to India, I think the kind of growth that we saw at the end of 2017 calendar year, since
Mm.
then we've been on a downhill. So 2018, 2019, we were already facing some bit of a slowdown. And then from there on, we had COVID which struck us. Now, do you think that we've already hit the bottom and we are on the path to recovery? However, if we are on the path of recovery, do you expect it to be bumpy or smooth?
Yeah, I think here we have to be a little careful because I agree that we've had a slowdown since 2017, but there were a number of
Mm.
factors, which were contributing to it. And one of the factors was that we had, credit tightening, liquidity tightening. We had ILFS because of that. NBFCs were not lending. Consumer credit growth slowed tremendously. Apart from people say demonetization was in 2016, and after that, the problem was that cash was withdrawn from the base of the
Mm.
economy.
Mm.
And then these other credit shocks meant that cash never went there. So if you talk to people on the ground, they say, "You've never seen the economy like this. There's absolutely no money to spend." Hmm?
Mm.
So now what happened in mid 2019 when there was a change of guard at the RBI, there was a turnaround in this liquidity situation.
Mm.
From being liquidity scarce at the aggregate level, it became liquidity surplus. And so then if you look at the high frequency data, by February 2020, there was a recovery in the high frequency data. No, so it's not true to say that we were constantly going down all the time. COVID made it worse. There was a recovery in 2020 February. But because in March, COVID struck, so that quarter also, overall, there was a slowdown. So if you just look at quarterly data, it shows constant slowdown. The reason I'm emphasizing this point is that what COVID enabled, what the RBI has done is very, very innovative and timely measures to pump credit to ensure that the financial sector remains, you know, the moratorium and the restructuring, etc. So this is exactly what the economy needed, given the liquidity drought that had been there since 2017. You know, so just as the reversal in 2019 led to a turnaround in February, I think this liquidity provision is helping the turnaround now. And that is the reason it is faster than expected, because people tend to think that the financial sector was in bad shape, everything was going down, the economy was going down, so they projected highly negative numbers. And so we must try to understand why these projections have not come true. You know, one factor was the uncertainty about COVID, you
Right.
know, how it would spread and that it's been relatively contained after September. That's helped the recovery. But also this reversal of the liquidity drought, as I call it, I think that contributed. That helps us to understand why the revival is better than anticipated. And so because of all this, I think that the economy has hit the bottom and is on its path, to come back to your question, path to recovery. And I think that the realization is there now that you need some kind of stabilization, fiscal, monetary. You know, earlier the focus was totally on reforms.
Reforms.
So
Correct.
regulation as well as everything was tightening together. You know, and making things difficult. Any economy, especially a modern economy, you need stabilization. You need something that's moving and counter cyclically. So as long as we will continue to have foreign shocks, but as long as this realization is there that you need to have some stabilization policies, I think the recovery will be smoother than we've seen so.
Right.
Yeah.
So taking this into consideration, Ashima, that the revival path has started, what would your expectation for the GDP growth be for FY21? Because as anticipated, yes, we will be with negative growth. However, earlier the anticipation was a double-digit negative growth. Now again, it's higher single-digit negative growth that we're expecting. What is your reading about the same?
I think because to work out this causality factor, I think it's important how negative it is. Because given the very large negative growth because of the lockdown in Q1, it's going to be negative overall. It's not possible to overcome that negative effect. But my own view is it's going to be low negative, like ranging -6, something like that, -6, -7, -8, between that range. Yeah. While earlier it was all double-digit negative expectation. Some people even went, I don't know, really, really expected very, very large slump. So, and I think that to understand these forecasts help. We must tease out those causal factors I was referring to. So, waiting for more data. We should see by end December how the restructuring goes, because one major factor is one of the predictions was the financial sector is going to go belly up, NPAs are going to rise steeply. When you talk to banks, they've raised capital, equity markets are booming, they have cushions, and they don't foresee a large rise in NPAs. Even after the moratorium, they find more people are repaying. So and since there's a better recovery to that extent, there'll be less distress. So I think that we will not have such a large negative shock. I see many sort of positives for growth apart from the credit, from the liquidity turnaround. One is that when you talk to industry, a lot of them are saying they're seeing signs, exports are doing better than expected overall.
Right.
We're seeing signs that countries want to diversify away from China. So India is a
Mm,
natural country to turn to. And also for global supply chains, this PLI incentives the government is giving, the tax cuts they gave, etc., which will work over some time. Then
mm,
we've seen pent up demand. I think it's not just pent up demand for electronic goods, for large consumption, because I think the better off households were saving, they're not traveling, they're less spending,
right.
you know, and also credit turnaround, because earlier there was so much, you talk to people, there's so much liquidity hoarding, people didn't know what would happen. They felt there's a liquidity drought there, which is sitting on that money, whether it's
Mm,
investors or firms or households. Now they've started spending.
mm,
No? So it's not just credit, it's liquidity, it's slightly different. No? So our
right.
credit growth also, there's a turnaround, but it's still not that high. But all this is making a big difference. Then we are seeing that motor cars were in the doldrum. There's this
Mm,
household substitution effect because you don't want to take trouble public transport. You're buying more cars. Car industry is turning around.
mm,
Real estate also, we are seeing people want larger houses and so on. There's some movement there. It was in the doldrums in 2007. No? Some turnaround. So I think then vaccines, state government expenditure on all this health,
mm,
all this is going to create some kind of stimulus. And I think that we should be okay on growth. And although the government has not spent as much as expected, as much as most economists were asking it to,
mm,
but given that in this quarter there was that festival demand, but overall the deficit has expanded because the year projection was 3.5. Now it's going to be 8 or something. So there is a stimulus of more than 4%. That expenditure, government expenditure is greater than taxation. So that is a stimulus. And this there was all these problems about how are you going to pay states. All that has been sorted out. So now both center and states have more money. And next quarter, when the festival demand slows down, they should be spending more,
mm.
right? So that's another stimulus which will be there in the next quarter. Yeah.
Right.
Hmm.
So with this, Ashiman, when we're talking of growth as well, do you think we will see a V-shaped recovery the way we saw probably during the time of, say, when the SARS came in?
I think it's already V-shaped. I mean, if in the Q1 it's minus 23 and then it's minus 7.5, there's a big turnaround there. So we'll see a turnaround in every quarter. And there remains that COVID-related uncertainty. We should not see a jump in the numbers after Christmas. We should not see this new strain spreading. That is a big uncertainty, right, which can
Mm,
damp activity. But without that happening, and as I said, I see a lot of growth drivers there. I think it's not just a turnaround from COVID, it's a turnaround from the earlier, because I think enough financial reform was done. A lot of banks had recovered big ticket from the IBC.
mm, mm,
And so NPAs are also not risen that much. They have cushions. And people look at, say, credit growth is low. But if you see, even firms were deleveraging because they didn't want, to be with large debt because of the IBC and the potential of losing their assets. So both firms and better off households are cash rich. So to that extent, what you're seeing in banks is they're not lending so much to firms, the retail loans are really going up if you disaggregate. And then other kinds of corporate bonds through private placement mainly, but then commercial papers, so on. So equity, large boom in IPOs now. Hmm? So there are other kinds of finance in the system, and this is healthy. It's a more diversified financial sector rather than, that all mismatch which you saw with banks. They're lending for in long-term infrastructure on lower term, shorter term deposits, which is not sustainable. Hmm? So we should not expect to see that kind of rise in credit
right,
from
right.
banks. Yeah, it's going to be a new and more robust financial system
Hmm.
now.
Right. So when you talk of this, do you think this is the time where the RBI can go ahead and ignore inflation numbers to achieve the desired growth? Or do you think it will be really, a mistake to ignore inflation at this current point in time?
The RBI is not and cannot ignore inflation. It's bound by inflation targeting. So, but I think we have misunderstood what inflation targeting means, because it's flexible inflation targeting, what they have signed up for. And technically that means there's some weight on the deviation of inflation from your target, as well as on the deviation of growth from capacity, as well as financial stability, because that affects both of these, right? So you needed some rise in liquidity to improve financial stability, because financial stability is hurt both by over tight liquidity and by too much creation. Yeah. And then because of this huge minus 23% negative potential output, negative, much below your potential growth, then you have to give greater weight to growth. Yeah. And at the same time, the inflation, because COVID was a very peculiar, both demand and supply shocks. Lockdowns actually just led to a total freeze on the supply side. So, inflation, we are still watching, but there's some chance that it will not be persistent. In fact, in November, it softened. Numbers have fallen below 7% headline. Well, WPI wholesale price inflation is just 1.6%. So it's not true that we are in a high inflation regime. There's a large gap between the same commodity, if you look at wholesale or producer or industry gate prices and retail prices. So a lot of this is because of the disruption of supply chains. And then we had unseasonal rains, which affected food prices. So these are multiple supply shocks that are responsible for this inflation. And you expect most forecasts, professional forecasters, etc., expect inflation to soften in the H2 of this year. Yeah? Come below 6%, which is the target. Yeah? So as long as you're within your inflation target band and growth is still much below potential, you're all right giving some stimulus. Yeah, but that does not mean that you're neglecting inflation, because you expect the shock to be temporary. If you expect it to last, then you have to act. Inflation targeting is forward-looking. You act on expected future inflation.
Right. So, Ashima, leaving growth and inflation aside, another pressing point that everyone talks about right now is with regards to the fiscal deficit. Because if the government has to keep giving out a stimulus package, one way or the other, they will have to go ahead and curtail their expenditure somewhere. With the increased borrowing by the center and the states, do you think there is a concern with regards to a fiscal crisis?
So, here we had so much advice, including from the IMF, that the government should just spend, it should have transfers for the poor who were more affected and who would have more demand and so on. But the government has been very conservative. It has taken the view that we can't afford to waste taxpayers' money. And every rupee must be well spent for maximum impact. And also India is a huge, the numbers of our population, kind of packages that the US and UK can give 30% of GDP. We try to give it, their population is 1/3, US population is 1/3 of India's. If we try to give it, given our numbers, GDP would really shoot, debt to GDP ratio would really shoot up in India. It's not practical. And then these very same people, all these FIIs would all run away and there would be a balance of payment crisis and country risk would shoot up, lending rates would shoot up, interest rates would shoot up. So I think that given that the government has been conservative, it has spent, as we've seen, the fiscal deficit has increased by 4.5%. If it's expected to be at 8, it was supposed to be 3.5 in this year. There is a stimulus. And they have spent, to protect the vulnerable by providing free food, and that's feasible given our large food stocks. It doesn't cost too much, you know. So, and then it has used the financial sector, the moratorium and restructuring, the credit warranty for SMEs, which is very good in terms of, but that doesn't immediately increase deficits, So they've a well-structured package which does not lead to such a large rise in deficit that it gets unsustainable. And some rise is warranted, in this kind of crisis because spending increases GDP and therefore reduces deficit ratios. So overall, I think, and it was sort of touch and go. A lot of us would have liked the government to spend more. Some people a little more, some people a lot more. I belong to the camp that would have liked a little more spend, especially on the vulnerable and so on. But overall, I think as long as they spend in this quarter, we should be okay because last quarter there was the festival demand. This quarter, they have room to spend more given the borrowing already announced. And so if GDP growth, and there's a large recovery in tax revenue, GST is doing well, so to that extent, they're not so dependent on borrowings. They have money coming in.
Right. So what would your view be on direct monetization by the RBI right now?
I think that you need cooperation between fiscal and monetary, and through all around the world, you're seeing that central banks are ensuring that government borrowing goes through at the lowest possible interest rate, supporting it through open market operations. But I think there's a misunderstanding where people think that an open market operation of buying government bonds is monetization. It is not. Because the reserve money has to be backed on the central bank's balance sheet by either domestic government securities or foreign government securities. When you buy dollars that come in and then you invest it in US or other foreign government securities. Yeah. So in fact, our Reserve Bank buys very little of government securities because they buy so much of US. There's so much foreign money coming in. So given all this excess liquidity there is currently, excess durable and short term, government borrowing can be accommodated. Yeah. And banks also, because credit growth to the private sector has not picked up so much. So there's a lot of money available to invest in government securities. So some support from the RBI in the form of OMOs, clever placing of the borrowing, support from banks, support from households, support from foreign investors who are coming back, flooding in, means that the government borrowing, whatever they've announced, can go through. It's at the lowest, as the governor says, I don't know, in so many years, in 10, 15 years, these are the lowest rates at which the government. So that cooperation, in terms of managing the government borrowing program, is keeping rates low, but it's not monetization. Whatever, even though there's large durable liquidity being created, not because the RBI is buying government securities, but because they're buying dollars that are flooding. But this is being sterilized in the reverse repo. Banks park the excess liquidity, so it's not increasing the money supply. Money supply growth is just around 12%. It's not excessive at all. So it's not creating, it's only creating excess short-term liquidity. Because of that, short-term rates have fallen. But this is overnight and 15 days absorbed. It doesn't lead to a rise in durable liquidity, which is the money supply. It's technical, sorry.
Right. No, but Ashima, see, with this, when we're talking about the fiscal side of it as well, and that that entire equation that we're looking at, from here on as well, what's happening is that there is enough liquidity what the RBI has created. There is enough liquidity with the banks. Yes, the government probably is pretty much tight with regards to where a stimulus goes. However, do you think we do have a bandwidth for an additional fiscal stimulus, number one? And number two, with regards to the liquidity also as well, which is available right now, the credit growth is still slow. So how does this entire equation then function?
I've written somewhere that I think what the government has to do in the current situation, once supply chain disruption goes away and the supply side is working normally, they have to make sure that demand is one step ahead of supply. Because that induces, private people can sell, it induces business activities going up, and they start, like you're seeing investment starting in cement and so on. So, so doing that doesn't mean a huge spending. It just means keeping a careful watch. And I think they're doing that. A lot of interaction with the market and seeing where the bottlenecks are and responding. Like we've seen a number of packages coming from the government. So as long as they keep demand one step ahead of supply, so that there are profits to be made, activity is humming, that is enough. That does not need huge spending. And so it is sustainable. As far as liquidity is concerned, the monetary policy stance is accommodative, which means liquidity will remain in surplus. It will be comfortable. There will be that liquidity drought is not going to recur. But maybe some measures will be adopted to reduce the large amount of excess we are seeing in short-term liquidity. Because that can lead to some sort of risks. Because one clever way of doing this, which I think was announced in the last policy, is to broaden the access to reverse repo. At present, only banks have access to it. So they can actually absorb liquidity from other parties at even lower interest rates. And so, that's not, but it does lead to higher borrowing, but very short-term borrowing has risks. That's what created risks with NBFCs, after demonetization, because all that cash went into banks and banks were lending to NBFCs and NBFCs were borrowing short and then lending long term, and that sets them up for a problem and they're not able to turn it around when rates rise. Those sort of risks should be moderated. Yeah, you keep liquidity in surplus, and there I think the regulation has to be, and now we have all sorts of exposure norms which will prevent that kind of large risk concentration.
Right. So Ashima, at what juncture do you think that the RBI should start withdrawing the liquidity?
They are not going to withdraw liquidity in the sense turn it into a deficit. It's going to stay comfortably so.
Right.
Just the very large excess that they will judge depending upon market conditions. They have much more, they keep in touch with participants and day-to-day what's happening, what the government borrowing program is like. They're managing that also so that the government is able to place at the lowest possible interest rate.
Right. And then do you think that the RBI should sterilize inflows through issuance of MSS bonds if the flows sustain?
Actually, let me say here that this is my personal opinion, not
absolutely,
just my personal opinion as an academic, not as a member of the MPC. Or that is an operational issue, which is they will see what the quantities are and what is required, and if necessary, they can have all kinds of ways of dealing with it. They have a number of measures, possible instruments in their toolkit. Yeah.
Right. And Ashima, very lastly, if we have to see, growth triggers in the near future, what, according to you, needs to be done to let the economy lift off when the tide starts to improve?
I already said that there are a number of positives for growth. So the government, and one of the problems in our economy has been excessive focus on reforms and long term, neglecting the short term. So, but that is also necessary because in terms of inflation, for example, we need to improve the supply side, so costs come down, costs of doing business, that reduces inflation eventually. So, so I was just looking at these questions. You want me to take them up or later? Or?
No, later.
Yeah. So I think long-term reforms should continue, but at the same time, this realization that you need stabilization in the short run. You need liquidity to be comfortable. So um, so as long as that is there, as long as you keep demand one step ahead of supply, that's
That's
for the short term. While you're working on those long-term reforms, and I think that long-term reforms, after a stage, questions that are very political, it's better to go slow. I think reforms by stealth work much more than upfront, which leads to resistance and demonstrations. India is a very difficult country to do big
absolutely.
reforms because some group or the other is adversely affected. And yeah, so I think they need to go easy on those or do them in a subtle way, not upfront way, and
Yeah,
make
but
sure
taking the
that
population also into consideration, I think, if there's going to be some part of the society which is going to have a negative impact of the positives that are done for the other parts of the society. So I think it's going to be that ways. Ashma, with the questions that are coming in, if you're comfortable, we could take them. If you're not, we can ignore those ones. So the first, I'll just read out the questions if you want. One is the SMEs are not getting loans in time for banks. So, how do you solve the SMEs liquidity problem?
yeah, my own view was I had made a suggestion that there should be some kind of wage subsidy because only, say, 10% of SMEs actually borrow from banks.
Hmm, hmm,
But at the same time, you only want to give loans to firms that are viable, So those who are registered for GST, now you have
hmm,
ways of tracking. And also cooperation between banks and fintechs who can give credit based on cash flows. So all these are um, I think the point is you want to help, but you don't want, optimize, don't waste that money, don't
hmm,
create MPAs in the future. So that's why banks, I think they are moving quite quickly on that. They're continuously being pushed. And but they evaluate the credit risk. Now it's not that you just give money, it has to be the credit, you have to look at the credit risk also, only to viable firms. you
hmm.
know or firms that are viable in the long run at least while you help them over the COVID shock period. So I think out of that credit warranty, more than two-thirds has been sanctioned. So I think money is going out there. And if you look, situation is improving on the ground in terms of money. And also demand has to, sometimes it's a demand issue. Firms are not borrowing because they are waiting for demand to come up and production to rise and so on. So I think it all happens together and slowly. It's not that instantly you're going to go into everybody getting money because you have to
Right,
do it in a well thought out way. Yeah.
right. And very lastly, money has been written off from PSU banks. So there is no productivity increase. How would you advise to control that bit of it?
No, I think this was our problem as a nation because we wanted to finance a large jump in infrastructure in the 2000s, but we shut our development banks. Corporate bond markets had not developed enough. So public sector banks were pushed into this. Partly they were over optimistic. So then, uh, to blame those banks is not, and I think that as a result of that, we have, as I said, we have developed a more diversified financial sector, the IBC and so on. Earlier, it was the public sector which was borrowing from public sector banks. So, but now it was the private sector investing in infrastructure. So you could not have the taxpayer refinancing this. It was not possible to recapitalize those banks. But in my view, the asset quality review, etc., came before IBC was there. So because of that, banks just stopped lending, and that really hurt the economy. You know? So now you have this that private sector also is bailed in. They stand to lose their assets. They have to be. It has to. So banks are lending on the basis of credit risk. So I think that there has been real reform that has strengthened the financial sector. And those loans which were written off, although banks have recovered something from IBC, was the cost of building infrastructure. It was it in every country. This is partially borne by the taxpayer. Has to be because the externalities there creates productivity economies.
Right.
Yeah.
All right, Ashima, I think thank you so much for sharing your views and insights. Great information that we've picked up from you as well. Great understanding. I hope you enjoyed the conversation as well. Thank you so
Yes.
much. Stay
Good
safe
to
and
talk to you.
hoping to see you back soon again. Thank you so much.
Okay, bye.
Thank you.